Hello, welcome to NDTV and BQ Prime. I am Neeraj Shah. Crises create opportunities, and no one in calendar year 2023 would probably suggest or kind of amplify that point more than Rajiv Jain of GQG. His bets into Adani Group at the height of the Hindenburg saga have paid off handsomely, as this graphic shows you. And I think the idea of requesting him to come on air today and talk to us about his thoughts around this whole saga, around India, around the whole investing piece, is to actually draw some lessons about how the man who manages such a large pool of money across the world thinks about this very basic tenet in the first place. Rajiv, great having you. Thank you so much for joining us on NDTV and BQ Prime. Lovely having you.
It's great to be here.
Okay, yes. I want to start off with the hot topic, of course, and which is this Adani Group bounce back, both on the markets as well as on the judiciary side. What do you make of it?
So I think I would say that we were not exactly surprised. We thought that a lot of the things that investigating has been investigated before. Obviously, it's kind of becoming a political football more than real economic substantive issue. That was our view. In fact, the bulk of the addition that we have done, which have been reported now, were done before the Supreme Court verdict. We have not really done much after the verdict. And on a cost basis, we have probably $2.4 billion give and take invest in the group now. So we did add, over the last 2.5, 3 months. Now, our view is that what we're buying is an entrepreneur who has done a phenomenally good job in execution. Look, India is a very difficult place to execute a lot of these complex infrastructure projects. We have seen some meaningful failures over the years. I mean, whether it's the Mumbai airport, the Mumbai transmission distribution assets, green assets by SoftBank, they exited. So many others have exited, or they're not profitable, so on and so forth. So we think extremely good execution. I've met the management team over the years, and I'm nothing but impressed. And the second part is the thrust from the government to roll out infrastructure. And these projects will go who can execute. I mean, you can't simply give it to people. I mean, if you look at the power crisis of 10 years ago, what happened? I mean, so many people failed. We're seeing that by the way, in green assets too. As interest rates have gone up, a lot of these assets would not be viable. And there's some fairly well-known marquee shops. So our view is that we were getting fantastic assets at very attractive valuations then. Less attractive valuation now, by the way, I have to say, because the stock has popped a little bit. And the Supreme Court issue is, in my opinion, kind of free and settled. I mean, look, they got a completely clean shit. I mean, somebody had an opinion about stuff, and we had a different opinion. We have to do our own work. I'm just surprised how little attention has been paid on the longer-term execution, longer-term growth story, and what has been delivered. I mean, that's real.
Yeah. Well, in some sense, Rajiv, you would be a happy man that the street reacted the way it did, because you've told before in multiple interviews that you don't like to pay up. You like to buy things at a good value, and you got the chance. Just that clarification, Rajiv, that you obviously just told me in this conversation that all the purchases that you did in the Adani Group stocks was done before the Supreme Court verdict came out and not after that, even though you are on record that, if I'm not wrong, that you want to be quote unquote the second largest shareholder in the group after the family, and you would want to participate in the future offerings from the group.
Yeah, I'm glad you're clarifying, because the market value with the market value. I mean, the stock might go down tomorrow, who knows? So we have around 2.3-ish plus minus 100 million invested in the group, various group companies. Okay, and bulk of, there's always, because we have dozen clients, there's always some buying and selling that happens any given day because of inflows and outflows which we don't control. But from a substantive perspective, the buying was pre-Supreme Court. And we do intend to participate in the follow-on offering, which will be primary issuance, because that is for the growth opportunities that they have. So we do intend to participate that in a meaningful manner. We're not looking to intend to buy the market here and now. So we have no intention of chasing any of these here. What the market will do, what the market will do.
Yeah. There is a thought, Rajiv, that infrastructure assets per se don't make money, if not the assets themselves. Then when they are listed in India, well, history is replete with examples of these companies not having made money. I would love to understand from you, when you think of infrastructure assets and your large investments into the Adani Group, and you have investments elsewhere too. There is ITC, HDFC, there are other names that have come about, and I'll talk about that. But just one question on the infrastructure assets valuing. How do you think about infrastructure in India or general infrastructure asset investing? Because the street seems to have a completely different view, so to say.
Yeah, so the infrastructure investing tends to be a little bit different than your consumer staples, IT service, so on and so forth. There's a long gestation period. You have to invest upfront. You get regulated rate of return. They have to be, by definition, leveraged. I mean, there's nothing like unlevered utility, regulated utility. That animal doesn't exist. Okay, it never existed before. So the notion that levered, anybody says utilities are levered, okay, that's fine. It's just an opinion, not investing that, but you could get very predictable returns for a very long term. So let me give you an example. If you look at, for example, Next Era Energy in the US, which is considered by any sort of astute observer will say that is probably the best utility in US. And actually happens to be out of Florida Power. They were originally called Florida Power Light. These guys are 7 times debt to EBITDA. And it's BBB minus. Okay, that's BBB minus versus US. You can argue is pretty much AAA. I think to AAA or AA plus. Adani Green is BBB minus also, but India is also BBB minus. So Adani Green is the same rating. So that's some rating issues. But from a debt perspective, the way you get paid is if you're getting, let's say, mid-teen return IRRs. Once you've invested in those, over time, the earnings certainty is very, very high, and hence they can sustain high leverage. Now, Adani is kind of unique because they are in a very strong investment phase even now. And what we've seen, for example, in ports, and ports is a very good case study, that after certain years, you will see a hockey stick of earnings come through. But you are in the phase of, sort of building that out. It is not like IT services, you turn on, you turn on the tap and revenue start coming in and you become profitable. Just a different business model. There's nothing right or wrong. So from that vantage point, a lot of these businesses have the free cash flow will come through later on as they keep investing. In fact, we don't want them to free cash flow positive. And on the debt side, we feel that, and my view has been they should not be cutting too much debt. To be very clear, the incremental capital that they're raising is for growth. India has ridiculous TAM, if I'm going to call that, because you're basically competing with state-owned companies. I mean, look at the state electricity boards. I mean, who wouldn't want to compete against them, right? I would love to compete against them if I could. I mean, talk about the most inefficient players you get in India, but it ain't easy. I mean, we saw the Reliance infrastructure in Mumbai. They couldn't cut it. I mean, GVK basically had to sell airports during COVID. So somebody said that how come the asset values have gone up, the airports have gone up? Well, if you buy airports in the middle of COVID, it'll come cheap, right? It was basically shut down. So these infrastructure assets have a very long tail. The returns are regulated by the government most of the time. After the initial setup, you get very steady return. So to grow, you have to keep investing more capital. So they're always free cash flow negative, but you get very high returns, right? On a long-term basis. So you get 20, 25-year visibility, which is why we feel that most of the Adani infrastructure companies that invested, we're actually not betting on, we're not taking any economic cyclicality risk also in these cases, which you are in other cases because, they will earn almost irrespective of what happens to the economy in a certain way.
In which case, Rajiv, you would be happy if a large portion of the street is valuing infrastructure in the way that it does and talks about the high debt levels, which in some cases is justified as well. But in the ones that you made an investment, you would be happy that the street thinks of them that way because you can get them at a good clip, at a price that you want, because you are really investing into them or thinking about them from that long-term mindset, which the street might not be thinking about them.
Exactly. And I think the little bit of disconnect is not a bad thing, right? So, I mean, frankly, the stocks have gone up is nice, but I mean, I'm not perfectly happy because in the follow-on offering now to pay a higher price is like, who wants to pay a higher price? I mean, it's nice if it went up, but I mean, we would have participated in a meaningful way in the follow-on offering.
Yeah.
Because the opportunity set is ridiculous.
Sure. I get that.
And nobody has executed it. If you look at the laundry list of failures infrastructure side, because you have to make sure you have access to capital, long-term stable capital, right? I mean, in India, it's hard to get long-term sort of stable access to stable capital. I mean, that's an issue. But the thrust of the government has made a big difference in making this possible.
Got it. Just one more question here, Rajiv. I mean, because you would have seen episodes like this happen, that there is, but this was too swift, wherein the fall was very large and then the recovery has been swift. What does this do to, a global investor's view about fundraising intents of a group like Adani Group? Because they have announced the intent to raise funds. You said you want to put in money, but I'm just trying to understand from a global investor's perspective, you reckon fundraising with all that's happened now and the Supreme Court committee verdict coming out and well, that it'll be smooth sailing?
Yeah, I mean, look, I think, to be clear, if others don't invest, it doesn't bother me. In fact, I like the fact some index funds are selling because it allowed us to buy some stuff, right? Sure. I mean, that's as close to dumb money as it gets. I mean, I don't understand a short seller writes a report on why is MSCI reducing weights in the indices. Some of this is total nonsensical. But look, if people weren't doing stuff like that, we wouldn't get an opportunity to buy either. And I'm not trying to be arrogant here, but I mean, there's some mandatory selling that happens when indices reduce weights, right? Yeah. So I don't see a problem in their ability to raise capital at all.
Yeah, and no arrogance. As you said at the start of the interview, some people have their view and you have yours, so which is fine. I'm just trying to ask you one last question here, Rajiv. You made a call which made headlines. I'm trying to understand what was investor behavior into your funds post that, because you are a large fund. Now, how did your large investors present then or potential which may have come into your funds post then react, behave, ask you about? Can you talk about that a little bit?
Yeah, so because there were a lot of headlines that how would an investor react. And the interesting is that first quarter was probably one of the best quarters in our history. I believe the third best quarter in terms of inflows in our history, GQG's history, which is not a long history, by the way, it's 8 years. But you had $5 billion on net new money in first quarter and $2 billion plus in March alone, right? So I mean, this has been extremely well received because a vast majority of investors, by the way, even especially sitting in India, there was this narrative without looking at the assets and the quality of execution that some of these have governance issues. And the more work we did, in fact, it's interesting that if I look at the total amount of work we've done on the group, we've probably done more work after the deal, more than 50 work after the deal than before than we had at the time of the deal. So we kept working on these names, which is kind of how we operate. We have a position, we're working on it, and if you like it, we increase it. If you don't like it, we reduce it, right? That's how I think about it, because you can't, you learn over time, and as we spend more time, we actually like it more, not less. So that's been the same response with our with our client base. It's been extremely positively received.
Okay. Would that be the view of people for your interest in India as well? Because you have a fairly large portion of your total assets, I presume, in India as a destination. Now, India is a cynosure of multiple eyes because of geopolitics, because of diversification, etc. But from an investor's perspective, how do you see India? How do your investors talk about India? I would love to understand that.
I think there's still a disconnect. I mean, everybody talks about India is expensive. And I said, look, I've been investing in India for, 28 years. I've never heard India is cheap. And the reason is because there are two types of markets. One is more cyclical markets. We tend to sell at low valuations. I mean, Russia was before it basically shut down for us. Or China, a lot of companies are cyclical. Or in India, you get a lot of cyclicals and low valuations. And we own some of them, for example, right? We own some of the steel companies. We like Coal India, for example, right? Those tend to sell at lower valuations. But if you look at growth businesses, and India has a lot of them, they tend to sell at higher valuations. That is no different. I mean, Accenture and Infosys are very comparable. They sell at similar valuations. How can you compare Infosys with, I'm picking a name, PetroChina in China? They're not compared to PetroChina, will sell at different valuations. So we feel that the growth story in India is actually getting better in a much more robust way. So we have had significant exposure to India over the long run, but this is probably one of the larger ones. I don't know, we have over 13 12.5, $13 billion, something like that invested in India, in very, very select group of companies. We tend to take a long-term view, and in the global context, is still underappreciated because the pushback you get, oh, India isn't expensive. Well, the problem is you're comparing apples with oranges. You can't compare a semiconductor name with Infosys, right? Semiconductor name would sell lower valuation than Infosys. And we don't own Infosys, by the way, just for the record at this point. So I think we feel that India, it'll be differentiated, it'll be diversified. Look, this administration has done a remarkable job of execution. I think that is the real important part of this. And that is accelerating growth in a big way. The banking system is clean now. The credit cycle, I believe, should be very robust. Real estate cycle should be robust. So if you look at our global book, this is probably one of the highest exposure in the global, in the global book in India.
Wow. And from the looks of it, maybe I'm presuming too much, but I presume that you are comfortable not only with keeping this exposure, but increasing it meaningfully over the course of the next few quarters, as the case may be, if things turn out right and you get the right value.
Yeah, exactly. I mean, you know, the stars have to align a little bit, but I mean, we have basically kind of a dozen names, and we have $13+ billion. So it's very, very concentrated. But our exposure, it's almost a given. It'll probably creep higher, particularly if there's volatility. So we need volatility. I mean, steady Eddie kind of hard to execute. And by the way, even Adani, we kind of thought that once the Supreme Court ruling comes out, we may not get an opportunity to sort of make sure we take our fill a little bit, right? So we did bulk of the buying pre the Supreme Court ruling.
Got it. Because that's twice the clarification that was necessary and which has come in from Rajiv Jain. Now, Rajiv, just a word on risk assets at large as well, because this whole theory of peak rates is now well and truly established, but we live in an interesting geopolitical world wherein news headlines around conflicts between the West and certain portions of the East are never ending. So how do you think of risk assets, both from a perspective of where rates are and where the central bank's balance sheet and their ability to, or their desire to pump in money, and geopolitics wedged into it?
So we feel that there's a tectonic shift that is happening because of the war. There's a clear separation happening between East and West, so to say. And there'll be some winners and some losers. Like Europe, we believe on the losing side, US will be on the winning side, and so on and so forth. And India would be on the winning side because access to cheap energy is critical. Europe, I mean, look, I don't quite understand this. They keep increasing sanctions, but the energy cost is basically forcing industries to move outside of Europe into United States. There's the IRA bill is the Inflation Reduction Act, as called. It'll be huge in terms of revamping infrastructure in US. And we talked to so many corporates in Europe who said we have no choice. Europe is not competitive. You cannot operate at $12, $13 LNG versus, let's say, $3, $4 pipe gas. A lot of businesses are not viable at that, right? So I think Europe is in trouble. In fact, by the way, Europe, if you look at it, their per capita income has been flat to declining for last 17, 18 years. That has never happened in the post-World War era. That's a real problem. So they've made it up by increasing debt. So debt to GDP has gone up by leaps and bounds. But now as interest rates begin to go up, it's a problem. So we feel while inflation is less of an issue, we were very concerned about inflation 2 years ago. Today, we are a lot less concerned. I think the trend directionally is heading the right way. The supply chains have normalized. However, the real growth problem in Europe, because they're basically over-regulating it, right? And one thing we like about India is that this administration is deregulating a lot of stuff. Like, I mean, if India has to grow, it has to deregulate and open up markets, make, ease of doing business matters. And Europe is going the wrong way. So I think the geopolitics helps India, particularly access to cheap energy, and US, in that mix. And this is a 5-year view, not a 2-year view.
Got it. Rajiv, in just a quick follow-up in that sense, a slightly medium-term question really, if indeed what you said about per capita is dissipating in Europe, the fact that export-oriented businesses have those challenges, and the fact that the East has countries where the per capita is growing, population is young and therefore demands more, would domestic-oriented companies stand a better bet of slightly medium-term success as opposed to companies which are largely focused on exporting to the West? Just trying to understand.
Yes and no. I think there'll be unique challenges, some export oriented, but some of them will do very well too. So I wouldn't necessarily extrapolate to export versus domestic. It really depends by business and industry and so on and so forth. And look, I mean, at the end of the day, what we have seen, what I have seen over my investing career is that you're still betting on the jockey. If you're betting on smart entrepreneurs who have shown the ability to manage the local environment, you're fine. You're not buying. You're not buying sort of a macro theme per se. And like, I mean, look at Indian IT service. I mean, they've done a phenomenal job over the years, and they'll do just fine. I mean, we don't own them right now for 50 different reasons, but if I take a fight, I think they'll be fine. So I think they'll do okay over the long run. But it's hard to say export versus domestic purely based on that.
Just wondering, what would be the 51st reason, Rajiv, which might make you look at Indian IT companies? Since there are 50 different because of which you don't own them.
I think there's a shorter-term headwind. I talked about in March that IT services we are very concerned about. Most of the companies have disappointing numbers after that, and I think the valuations are still a little bit on the higher side. There's still some risk on the AI in the short run in terms of the demand supply side. I think the visa issue is going to be a little more problematic go forward. These companies will manage all of that, by the way. But look, I think our real issue is that we only have so much capital, and we would like to run constant book. We don't have to own everything.
True.
And from a risk reward perspective, those are they're ho hum. They're not juicy enough. And as I said, I made my living trying to sort of make money off what sort of passive funds do. And a lot of folks are forced to own that. We are not.
Yep, sure. Last couple of questions, Rajiv. One is on this whole piece around ESG or the pushback that we are now starting to see, not just from companies, but from countries as well. Now, where are you on this argument? Because I heard you make an interesting point about an Indian asset, which is also quote unquote anti-ESG. Where are you on this whole ESG argument and whether the multiples derate or whether they go up because the world may have no alternatives?
Our view is that we want to own companies which are actually going to improve the world. Okay, but to simply say no fossil is a little bit delusional. In my view, is anybody says no fossil, talks about banning fossil. I mean, unless you wear no polyester, you use no plastic, you only use candle for light and live in the caves. Then obviously it's perfectly fine. You need fossil. So some of these assets are being given away. I mean, coal assets, for example, and some some of those kind of businesses. So our view is that we want to own companies which have good governance, good longer term prospects, and be on the same side of the owners. So we'd be happy to own them. I mean, people forget that was not that long ago. Coal India, for example, used to sell at 20 plus times earnings, and it was called a compounder. And now it's at 6 times earning 10% dividend yield, right? And it's as steady as a business it gets. And India does need coal. There's no question about it. But I think the energy chain in general is very attractive from a longer term. And we have significant energy investments, by the way, after not owning for almost 10 years anything in energy. I hate to say we had no energy, but we had almost no energy investment for the longest time. And last 2 years, that's become one of the biggest areas of investments. And we continue to look for opportunities in those areas.
Just one quick word on the other India piece, because you mentioned about rattling the cage and what it does to business. Now, that is with regards to one of your investments, but you have large investments, as you said at the start of the interview, $13 billion, if I'm not wrong. There is ITC, there is HDFC. I believe recently you guys exited the AMC space. And today morning or last evening, your name has come, a small one, but your name has come into one purchase in a healthcare space as well. Talk to us a bit about your India exposure.
So, we try not to sort of show our tracks, right? So sometimes they by regulatory reasons, it has to be disclosed.
True.
Because we have literally dozens of clients. So it's hard to sort of do a picture in totality how we are exposed. But I think it's few buckets that we quite like, besides infra type businesses, and they are sort of, some, like cement type exposure and so on and so forth in that. But we obviously still like the banks. We do like some public sector banks. I mean, I talked about them along with private sector banks. We did not own public sector banks for the longest time, but we do like them now. And along with private sector banks, that has been a sort of a core area for, 2 decades now. I mean, I remember meeting Aditya Puri, 20 plus years ago, and that became a core position for the longest time, not to mention HDFC and so on and so forth. So, I mean, I think we first bought HDFC in 98 or something. So we owned it for a long time, and in a big way from our vantage point. So we do like the financials a lot. There are some really fantastic management teams. And I'm talking about globally, by the way. I mean, some of these management teams are some of the best in the world, I would say, whether in developed markets or emerging markets, no question about it. So that still remains. So if you look at infra type businesses, financials, those are two big. In staples, it's pretty much selective 1 or 2 names. We don't own some of the names that we used to own before because of the valuations and growth has slowed down. And the third one, a little bit in the healthcare side. We do like the long-term healthcare. I mean, obviously, one was disclosed, as you said. It's a relatively small position, but I think healthcare in general would be an attractive space over the long run. So I would say these would be some of the bigger ones today. We don't have anything in IT services type names. So
okay, yeah, but that's a pocket that the 51st reason, if it comes about, would make you interested because you do like the companies, as I'd heard, just that the valuations may not be favoring you.
Well, valuation, and I think there's shorter term headwinds. But it's also a part of that is we have to move capital around. I mean, I wish I could just own them and leave them. You'll be fine. But we have only 100% to invest, right? And it's not an India fund. So we have significant exposure. So if I need to buy Adani, I need to sell something too. I can't simply keep adding, right? So that is how the capital moves around. What's the most bang for the buck you can get? And that's part of the reason that we thought there's much better risk on Adani than some of the IT services, 3-4 months ago. And even, by the way, this is not a 2-month view. Frankly, I did not expect them to rebound as quickly as they did. I thought they'll take a longer time. And that's why we thought we'll have to sort of nibble, which we did over the last 3 months. So I think a lot of that is sort of risk reward. See, if you look at last 10 years, some of the steady Eddie businesses have gone re-rated quite significantly. Those are the ones which are tough to call. They are very good businesses. Would they do well here on a continued basis and justify the valuations? That's tough to say. There's downside if you ask me, because if the earnings growth accelerates in areas that have struggled, infra, cement, those kind of names, I think the capital will leave some of these steady Eddie compounders that have been re-rated from 20, 25 times 10 years ago to 50, 60, 70 times now, right? I think that shift could still happen.
Okay, just one quick follow-up though, if you will, allow me. The argument could also be that in a country wherein the per capita is moving from $2,200 to $5,000 at some point of time, and the population still is growing and is young, the consumption of some of these steady companies where the valuations have grown might actually stay at elevated levels and keep the valuation levels higher. And therefore, why not those as opposed to taking a bet on businesses which may or may not necessarily succeed?
Yeah, but look, I mean, markets are cyclical and like human beings, our mood changes, right? I mean, be very unhappy in the morning and very happy in the evening. So would these businesses stay at 60 times? They've gone to 20 times before, from 60 times, by the way. I mean, I can give you ITC history. I mean, it was around 40, 45 times the early 90s, okay? And I remember in early 2000s, people pushing back that these things always, they were 8, 9 times earnings by the early 2000s. Okay, this ITC. It went back to 35 times earnings, went back to 12 times earnings. So sentiment changes. So it's a relative growth, earnings growth that will matter. And from that vantage point, I think the advantage might shift to different areas. That's the call. Look, we may be wrong, but that's the call we have to make.
My final question, Rajiv, more a macro question of sorts, and which is around this whole concept of short selling. In India, it was a big scare, probably the first real scare that India saw on short selling. There may have been others, but this was the first real one. But the world has seen enough of it. Now, what are your thoughts here? Because some people say, hey, they are vultures, and some people say they are necessary for price discovery.
So, I mean, the problem is when you're rattling a cage, like what happened, in this case, there are real business implications. So I do feel that this probably will be investigated, and And I wouldn't be surprised if some of the banks or players would lose access to India. I mean, look, I wouldn't be surprised at all because of what has happened. Now, no problem with short selling. People short sell all the time, and that's probably fine. But to go out and rattle a cage sometimes can have business implications, which can be, which may be problematic. So, I mean, I think short selling is fine as long as you're not sort of, rattling the whole world around it. That's my personal view. But from our vantage point, I mean, I'm not complaining because it also creates the opportunities for us, right? So, I mean, it's how do we make money otherwise? As they say, for a market to exist, there have to be two opinions. There's no market, everybody agrees.
Rajiv Jain, such a pleasure talking to you. Thank you for all those insights. Thank you for the clarifications. And this whole piece around how to look at infrastructure was really good. So thank you for all of that.
It's great to be here and good to talk to you, Neeraj.
Likewise, and viewers, thanks for tuning in.